Hello everyone. In this video we're going to go through homework for chapter 10. The actual assignment will be a little bit different from this demonstration, so be careful. Alright, so the company purchased a tract of land and they have to pay additional fees, and the appraisal value for the land $500,000 and the old building $100,000, and after acquisitions they have to pay to raise the old buildings for $34,000, and after that they start construction. Okay, so let's see the construction. March 1st and ended on December 31st. Right? They borrowed money, $4 million to construct a new building. It's 10-year loan, interest rate 10%, and interest will be paid every year on March 1st. Alright, so, and the following are expenditures made during the year. Alright, so this is the basic setting. The question is asking for the cost of land and the cost of the new building recorded on the accounting, on the financial statement. Alright, so first let's get to the cost of land, which is very straightforward. Everything we paid for the land, everything, including the purchase price, right? And commissions, legal fees, and also insurance, title insurance. What else, right? And also the in order to make it ready for use, we have to pay $34,000 to make it ready. So all these 5 expenditures will be recorded as cost of land. Cost of land. So we can just put, all these numbers into the cost of land. All right. Next, we're going to get to the cost of the building. Cost of the building. To record the cost buildings, all these expenditures will be the cost of the building, right? Well, these are expenditures. In addition to these expenditures, we also need to consider the interest capitalizations. So the key of this question is interest capitalization. So let's get to the interest capitalizations. So I'm going to prepare schedules to capitalize interest. So we know it's a qualifying assets. We're going to interest capitalization start on March the 1st, ended December 31st. All right. So those are the basic setting. Now we're going to calculate the weighted average expenditure. So March the 1st, we spend $600,000. Okay. So we're going to calculate avoidable interest. How do we not spend it? Spending money, how much interest we can save. In other words, now we spend $600,000 March 1st. How much interest will incur from this expenditure? Okay, so interest will incur from March the 1st to December 31st. In other words, we have to incur 10 months of interest. Okay, so the capitalization period will be 10 over 12. And we're going to get weighted expenditures on March 1st. And this is going to give us $500,000. And we do the same thing. On May the 1st, we spent $900,000. Because of that, we have to incur how many months' interest? 8 months interest, and those interests are avoidable. Then October 1st, we spent $1.2 million interest. Well, we capitalized for October 1st, 3 months, right? 3 months till the end of the year. And finally, December 31st, we spend $1.5 million. We know the avoidable interest, the capitalization period is almost zero because we incur almost zero interest on the last expenditures. All right, so we can calculate the total weighted average expenditures for this construction, and we get $1.4 million. And from this number, we're going to calculate avoidable interest for the year. We're going to apply, because we borrowed money to construct, right? So we're going to find the cost of borrowings. We're going to apply the cost, the interest rate, onto this weighted average expenditure. So from the question, we borrowed, and let me see, $4 million, okay, which is enough to cover the $1.4 million expenditure, and interest rate is 10%. So we're going to apply 10% to get the avoidable interest. Very straightforward, which is $140,000. So if our borrowings is less than $1.4 million, for example, $1 million, then we can only apply 10% on $1 million, and the rest, $40,000, we're going to apply a different interest rate, which is cost of other debt. So in these questions, our borrowings is large enough to cover the whole expenditure. Also, we need to verify the actual interest during this 10 months period. All right, so if you look at questions, we don't have other debt. So the only debt we have is $4 million. Okay, which we borrowed at 10%, but because we only calculate 10 months actual interest we're paying for, and it's going to give us right, $333,333. This is much higher than the avoidable interest. Therefore, we're going to capitalize a lower number, which is $140,000. All right. The journal entry is very straightforward. We're going to debit the building, basically. And credit interest expense, right? All right, once we do this journal entry, you can calculate the cost of the building. All these expenditures will go to the cost of buildings. So if you do the calculation, the total number, $4.2 million. So the construction itself is going to give us $4.2 million for the cost of the building. And also we capitalize interest. Okay, this becomes the cost of the building, right? Therefore, the cost of the building, if add them together, is $4,340,000 cost of the building. All right, so this is the first question. So the second question is a non-monetary exchange in which we exchange our assets with another company's assets. Okay, we may or may not pay or receive cash. A small amount of cash could be involved. So let's look at the setting. So a company exchanged equipment used in manufacturing operations. Plus $7,000 in cash. Okay, so obviously we paid cash. Okay, in exchange for another assets. So these informations are for our assets, and these information are for the assets of bigger corporations. So we're going to exchange this one for that one. All right. So part A, assume that exchange lacks commercial substances. We know that commercial substances means the financial position will change after the transaction. So if the transaction lacks commercial substances, it's not going to affect the cash flows for both parties. So nothing's going to happen. Life is going to be as usual. So what's going to happen here is we're going to look at the book value of our original or old assets. We know the book value, right? Book value is the cost, right, minus any accumulated depreciation. So the book value in this case is $144,000 minus $36,000. So that's $108,000 book value. And the fair value for our old assets, right, which is given, $125,000. Okay, so we are disposing an asset with book value 108 for 125, right? Obviously we are having some gains from these transactions. Okay, however, because we are not receiving any cash and the transaction lacks commercial substances, we recognize zero gains, right? Recognize zero gains. The transaction lacks commercial substances. All right, so we can do the calculation. We'll finish the journal entry now. The first step, I'm going to get rid of my old assets. So I'm going to credit equipment. This is the old equipment. I'm going to get rid of the cost. And also on the balance sheet, we also have accumulated depreciation, which has a credit balance. So I'm going to debit accumulated depreciation to get rid of the accumulated depreciation. Okay, so I get rid of the old assets. All right. So what else I'm giving up? I also will pay cash, credit cash, $7,000. And I'm going to get the new assets. So I'm going to debit the new equipment. You can just do the plug-in value, right? Total credit minus total debit. We're going to get a number. All right. So another way to get this number, also the formal way to get this number, we're going to determine the assets acquired by the value we give up. Okay, by the value we give up. So how much we are giving up in this transaction? All these are measured in in fair values. The value we give up include $125,000, the old assets, and plus $7,000 cash. So the total value we give up is $132,000. Okay. If gain will be recognized, the new assets will be recorded at 132. Okay. However, because we cannot record any gains for this transaction that lacks commercial substances, okay, we need to subtract the gains. So the gain deferred from these transactions well, if you do the calculation, we have to defer the whole gain from these transactions. That's going to be $17,000, right? So the gain will be deferred, and therefore the new assets will be recorded as the value we give up, total value we give up, minus the deferred gain. Okay, it's 115. All right, so we have two ways to determine the cost of the assets acquired right here. Either will be fine. Okay, if we look at the other company, the counterparty, Viego, can do the same thing. The book value and the fair value. No, this is not book value. This is the original cost, right? So book value is going to be the cost minus accumulated depreciation. So it's 130. Fair value 132. All right, there's possible $2,000 gain. Possible gain is $2,000. Can we recognize any gains, especially when the transaction lacks commercial substances? Yes, we could. Why? Because in this case, for Viego, we are receiving cash. The company is receiving partial cash, so it has a chance to recognize partial gains in this transaction. The partial gain is determined by the total gain, which is $2,000, multiplied by the percentage of cash received compared to the value of the transaction. Okay, the total value of the transaction is $132,000. Right, so if you do this, we have a chance to recognize partial gain. So you got the answer. What is a partial gain? Right? It's approximately $106. Okay, partial gain. This will be recognized. So the gains deferred from this transaction, total gain minus partial gain recognized. So we're going to defer $1,894 deferred. Okay? In other words, the new assets acquired will be the value we give up minus the partial gain. So how much we have given up? So we give up $132,000, the fair values, but we receive cash. This is the value we give up, right? Going to minus the partial gain, or the minus the deferred gain, and this will be the cost for the assets acquired. How much is this? All right, $123,106. So we can finish this journal entry. So we're going to debit equipment. Okay, the same thing. We're going to get rid of the old equipment. So we're going to credit equipment, the original equipment. We're going to get rid of the accumulated depreciation. Okay. Also, we receive cash, $7,000, debit cash, and finally, we this one, right? We have a partial gain recognition, so we credit gain. So you can check the total debits equal to total credits. So we finished this one. Or you can leave this one, okay? Once you get the partial gains, and this number will be a plug-in number to make this transaction balanced. Okay, so either way will be fine. And part B, in fact, is much easier because now we have commercial substances, so all the gains will be recognized. All the gains will be recognized. So we're going to do the same thing. It's the book value for the assets, and this is the fair value. So the total gain will be recognized. $17,000 will be recognized. So if I recognize the total gains, back to this one, if I recognize the total gain right here, the value of the assets acquired will be determined by the value I gave up. So I gave up $132,000. Therefore, the assets acquired will be recorded at $132,000. Okay. So I debit equipment, $132,000. I'm going to do the same thing. Get rid of the old equipment. And pay cash, and recognize the whole gain. All right, total debits equals total credits. We finished this. Okay, so I'm going to go through bad deals. Again, all the gains will be recognized. All right, if we have loss situations, that's much easier because no matter whether we have commercial substance or not, loss is always recognized. Always. All right, hopefully you enjoy these videos. All right, and see you next time.